Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Thanks for tuning in. We're talking about finance today, mortgages, which, as many of you know, is critical to investing in property. And one of the key differentiators between those that do it really well and those that do it very well and those that don't do it so well, finance is usually the thing that holds most people back from amplifying their investments and achieving and realising their property investment dreams. I get together a couple of times a month with Eva Loisance from Finni Mortgages to chat through things, all mortgages. We're going to do that today, and we've brought in I wouldn't say special guest, I'd say a guest to help us navigate what we're going to be talking about. That's the 10 most seen investment mistakes, and I think this guest's probably seen them all as well. Eva, how you going? You well?
Great.
Good to see you.
Yeah.
Nice to be doing this in person.
Yes, exciting.
Yeah.
I'm excited to talk about that as well, because if this could be avoided early on in the journey, that would really make a difference.
So mortgage brokers would rather not be fixing people's problems. They'd rather be helping them to do more good
Get
stuff.
ahead, yeah. We do a lot of fixing, unfortunately.
Is that like how do people get it so wrong? Poor advice?
They just don't know. They don't know.
Yeah.
They don't even know they got it wrong until they go for the next property.
How do you tell people they got it wrong? I guess there's known unknowns, unknown unknowns, or whatever it is, right? Like, how do you say to people, this ain't good?
Then they come to us often because they are stuck, right?
Yeah,
and they're like,
okay.
so how do I get to the next property? So it's more about, okay, well, if you want to do this, you need to do that. Or if you can't do it, it's because you did that, or you didn't see it that way, or you missed something in the journey there.
Well, I guess the good thing, or one of the good things about what you do at Finni is that you work with some of the best buyers agents in Australia. We've had some of them join us for a chat. I think about Archer and Pallywell for InvestorKit, for example. So because of the clients that you're supporting them through mortgages, you probably see warts on all everything. No doubt, out of the best buyers agents, you probably see a lot less mistakes, or you're probably helping to fix the mistakes they've made before they've gone to a buyer's agent. But
at least they get properly right.
Yeah.
So that helps for the journey of buying more, and they do guide them through going through a broker. So that also avoids a lot of issues. People that do it on their own through a bank, often they would cross properties, or they would not use the equity properly.
Yeah. So why is it, do you think that some of the best buyers agents in Australia are choosing to work with Finni Mortgages to...
Because we understand investors as well, and investment. All our brokers are investors themselves. So we've been through the journey, we made our mistakes, and we can share the story and make sure people avoid it.
You haven't made too bad mistakes, have you?
We've made mistakes.
Everyone makes mistakes, particularly Paul Glossop, who also, from pure property investment, who also turns to Finni to support his clients through mortgage financing. Paul, you see it all, don't you?
Thank you, Philip.
Yes.
The hostess with the leases.
The hostess with the leases. But you're here as well because we're off to a function this evening.
We are off to the inaugural Property Investment Professionals of Australia Excellence Awards this evening. So we've got my penguin suit hung up somewhere, dusty because I don't use it very much anymore. A lot less than you do because you're probably multi-times a week functioning.
I do go to a lot of
belt
functions.
straps too often.
No.
But yeah, we are. It's and speaking of some of the best buyers agents in the country, we'll be saying g'day to a lot of them tonight.
So how do you feel about, like, you turn to Finni to support your clients with mortgage financing, and also some other very capable and well-known buyers agents turn to Finni for helping the clients with mortgage finance. We spoke about Arjun Pallywell. I know Sam Gordon from Australian Property Scout also turns to Finni for some of his deals. How do you feel about other buyers agents sort of getting used to the best team in Australia? Do you sit there and go, no.
It's an interesting one because when it comes down to it as a buyer's agent, you sort of initially think, I've got to be very protective of the company that I use to finance my clients' structures, and you think, I don't want anyone else to grab the access and basically take away the bandwidth for them to do the job for us. But the reality is, and how Finni works with both my buyer's agency as well as many others out there, is that they have the ability to essentially probably go through the process of probably pipelining exactly where the client is, who they work with, and who their buyer's agent is, but probably more so they staff and resource correctly. So ultimately, if there's more demand, they have the ability to process and administrate correctly to say, let's essentially triage who that client should be working with, who the specialist in the brokerage space should be that's going to work best with them, and then essentially get that job, whether it's a trust structure, whether it's a first investment, whether it's a client who's got 20 investments in a spreadsheet as long as your arm, and you have to go through that line by line. I know Eva and her team have different brokers who probably specialise in those spaces. We've got accountants in the team, lawyers in the team, people who have the ability, technical ability to go through each one of those different loans correctly. So I have the confidence, but I also have the confidence to know that my clients aren't going to get meddled with other buyers agents' clients. And I guess one good thing that they've assured me is that every client who goes to them essentially gets tagged as a pure property investment client. So I know that if the client goes to them, they come back to pure property investment with the correct advice. And then our job is, as buyers agents, go into those markets to secure and negotiate the correct asset.
And I think that's what sort of constitutes a good buyer's agent, is to know what they're good at, and the ones that Finni work with, from what I understand, are very good at being buyer's agents. And much like your business, their business as well is all about ensuring that your clients have the best team around them. And if for many of them that's Finni Mortgages to do the finance bit, that makes a lot of sense. So shout out to all those buyers agents who we know well, who are also leveraging the capabilities of Finni. And for disclosure, and I'm big on this, I think Finni's such a great business. I invested in it. You did the same, Paul. And it's important that our listeners know that. But it does get results.
Yeah.
Absolutely gets results. I use Finni for my
do I.
mortgages. And they do most of the time a good job, Eva.
Most of the time.
That's a compliment, by the way.
From you, maybe, yeah.
Yeah, it is. It definitely is. Yeah, ask a couple of your bankers who you've accosted in the past. Yeah.
No, that's a pretty good a pretty good compliment. But the 10 most seen investment mistakes. So I brought Paul in just so we can get a bit of a lens through a buyer's agent side of things, because as I said at the start of this podcast, everything is interconnected, right? Like property's a game of finance, and the best people that I know have a really good grasp of how to use finance effectively, but that has helped shape their buying behaviour. So it's all interconnected. The one piece of the puzzle we're probably missing here is a accountant who we could probably bring in, who I would say would be another key capability for me. Buying, the accountant, person who does my finance and where to buy is my A team. But top 10 most seen mistakes. The first one here, Eva, is wait for a 20% deposit or for the property market to crash.
Yes.
It's like waiting for Godot, which I remember from my
I see.
first year literature at uni. Are you familiar with this?
You're showing your age, Philip.
No, it's not one of the
Showing
classic.
your
Essentially, a guy that's waits around forever and nothing ever happens.
Yes.
In a summary, I got a high distinction with my paper on that.
Of course you did. You and Harry Dent.
Harry Dent. But waiting around. So most people think, a lot of people think when they're new to the game, that you need a 20% deposit.
Yeah, and I hear that.
And you should only
every
buy
week still.
when market's at the bottom.
Yes.
Buy low, sell high.
Yeah. So we're still waiting for that. We're waiting for the
When's
crash.
that going to happen? When's the crash going to happen?
Soon, right? So let's wait. Let's all wait, but it just never happens. And people are sometimes surprised when I say you only need 5% or sometimes 0 if you've got family that have properties, you can use the equity. So technically anyone, even with 0, and I really mean 0, can start today.
With a family pledge.
With a family pledge.
Yeah.
Yeah. So why would you wait? The property market might crash one day, but certainly might not. So you could be in a property right now and enjoy it now. Whether it's investment
but you got to pay
or
LMI, even. That costs a lot of money.
not really. Not really at all.
And I think,
Can you put that in a perspective? Like, what's a normal size property?
Let's
like,
say investment 500,000. You would find
absolutely.
you'd pay $7,000 LMI. It's tax deductible. It's added on top of the loan, so you don't even have to come up with the money up front.
You got to pay it off over the life of the mortgage.
Yeah, but
and
it's
put
tax
interest on
deductible.
it.
It's tax deductible.
Yeah.
So it's really, if you think about $7,000, if you wait for the market to do its thing, within a month or two,
it's
you
funny
would have.
pick that number though,
that.
Eva. So I put $500,000 into a compounding calculator just now and say, okay, well, let's say you've got two choices. You've got potentially, let's say 5% saved, but you're waiting for 20%. So what's 5% of $500,000? Yeah, versus trying to find that 20%. So essentially waiting to save that from $25,000 to $100,000, trying to find that extra 75 grand. How long will that take? Let's say you're saving 25 grand a year. That's 3 years. Let's say you wait 3 years to get your 20%. So that $500,000 property in 3 years' time at 7% compounded, you've saved $7,000 on LMI technically. that property is then worth $612,522. So $7,000 cost you $112,522 minus $7,000. So let's say $105,000 it costs you to save $7,000. And that's where people, first-time investors in particular, I find, that's where a lot of that education has to start. Because if you don't do those numbers and you think purely I'm paying this insurance to some random bank and it's a cost of doing business which I'm not comfortable with, you've got to look at the opportunity cost. And that's a massive one. Phil, you've been there. I've been in LMI territory more times than I care to count in my own portfolio early in the piece. It's not all the time, but early in the piece, it's an enabler.
That's what the people that sell LMI would want to tell you. Hey, you guys sponsored by? I don't even know. There used to be a few of them around.
I think their actual share. I think their share price has done all right in the last few years, in particular.
And we've spoken about the family pledge beforehand, so we don't need to go over it again. Go and tune into some of the previous episodes about how that works. So another major mistake seen by Eva and her crew, and it's growing team as well, right? We spoke about new broker that you got on recently, who's doing pretty well.
Yeah, we've got Robert, who started a few weeks ago now.
So he's an accountant by
former
trade.
Accountant. So
why is it
Come from the dark side.
Trader. He's now a mortgage broker.
Yep, I think he was a bit bored with his Excel spreadsheet, and
Now he's got more of them in droves.
more of them now. Yeah.
Does he like doing financing for people? Does he?
Look, he's been a broker for many years, but his trade originally was accounting.
He's a bean counter.
So he really,
I don't mind that. That's pretty good. And he may tell you this, using cash instead of owner-occupied equity. So this is where people think, again, they've got to save up money, which keeps them out of the market longer when they can potentially take some cash money out of their
home
owner-occupied to get
their
started
first
quicker.
property. Yeah. So we see that a lot. Yeah. So people, again, waiting 10-20% deposit to go for the second property, or sometimes they've got their home and they're saving, have the money in an offset and waiting for that to grow so they can buy the investment property. What they can do is put that cash towards the non-tax deductible debt, release the equity again, and then invest. So at the end of that, they have more tax they can tax deduct and less to pay on their mortgage every month.
So does it work? So if I've got owner-occupied debt, right, which isn't a tax deduction, if I refinance the owner-occupier loan and the money that I use to put into investment properties, that bit connected with my principal place of residence debt can be a tax deduction? Is that correct?
So let's say you've got 100K ready to go,
Yep.
and your loan is 500,000. If your capacity is limited, you would put your $100,000 to reduce your home loan to 400 and get that 100 back out as an investment split tax deductible.
Okay.
So you end up with the same amount of debt, but you've got more that is tax deductible.
Okay.
Yeah.
So that's good for taxation.
Or even if you didn't have any cash in offset, so let's say hypothetically you had $1 million asset and a $600,000 debt, and you say technically, okay, well, if you have the serviceability to take out, let's say $150,000 to cover a 20% deposit plus 5% for closing costs, that extra $150,000 you take out is then therefore tax deductible as long as it's used for investment purposes. So you don't
but you've increased the
need
debt on your principal place of residence.
Correct.
However, the bit that you've increased, you can get the tax deduction off it.
Exactly. And I think the key there,
investment.
and I think I'm trying to think who I spoke to very recently about it. It might have actually been Ross Lacane. I remember speaking, who's one of the best brokers in the country and was a broker for the best part of 25 years. Now coaches brokers. He explained it so well in the sense that he's a prolific property investor himself and avid in the sense of trying to educate people on understanding this. But the enabler, and it goes back to those exact same numbers we just talked about for people waiting to save 20% versus using whatever they've got available, whether it's a family pledge, whether it's equity. You do the same numbers and you say you're waiting to save a certain amount of money to offset to use that cash. A, you're losing tax deduction, but B, you're losing time of having exposure in the market. So that's a double whammy for me, because if you're sitting there and you've got serviceability and actual equity usable, and you're thinking, I just want to wait till I've saved up cash, not only might you able to actually release that equity for a deposit, you might better release a little bit extra to give you a cash buffer. And it comes down to cash flow. And I think to your point, Phil, if you're buying a property, an investment property using equity, technically you're borrowing 100% of the purchase plus 5% of the closing costs. So you're borrowing the maximum amount you possibly can. You've got to model your cash flows, and I think that's what a good broker does. It says, look, the money's there available. Just make sure we can do the funding. Do you have surplus cash? And if you do, then you've got to be comfortable to say, hey, you only need to find this amount every month. And that's really what your mindset has to switch on, as opposed to saying my debt's exploding to whatever the number's going to be. It's how much more do I have to find based on the extra rent that I
fill
achieve.
the gap.
That's it. And that's the only number really that makes any difference.
Well, it is, particularly if you're early on in investing. It's probably different recommendations for people at the other end of the spectrum. But people, and most people, Paul, are probably trying to accumulate property as quickly as possible once they actually understand the mechanism that is property investment, right? But this is the mistake that people make. They do the wrong financing structures and then they get stuck. Another place they get stuck, and sort of third most seen investment mistakes, is sticking with only one bank. My family's always banked with them.
The old Dolomite account.
And you know what? It's often with CBA.
Yeah, okay.
Yeah, they do. I don't know.
Oh, yeah.
The clients do love them. I don't know why, but
CBA hate brokers, I'm told these days.
It sounds like that.
Yeah.
Anti-broker.
Even though I only heard today, mortgage broker market share has gone up to 75%, the highest
75
ever.
now.
Yeah.
Wow.
Yeah, there's been a whole bunch of commentary coming through the Financial Review recently, appalling journalism.
Yeah.
Pretty much saying
You've done your best to really rev them up.
CBA at war with mortgage brokers, is what the AFR is telling us,
Right.
which is, they've copped a huge amount of backlash.
Yep.
Joke journalism,
Yeah.
right? And they haven't done themselves any favours, the AFR, I tell you what, particularly with the mortgage industry and also with banks, right? Who, they complain and they're crying poor at the moment, saying there's no margins in lending at the moment. Yeah, it's a bit tighter, but home lending business is generally pretty good.
7.8 billion profit as opposed to 8.4 billion profit.
You've got to take a haircut every
You do,
now and then.
you do.
But brokers are important. So one of the benefits of using a broker, you'll tell us even, no doubt, is that you won't make the mistake of only sticking with one bank.
Yeah, and for a lot of reasons, obviously, different products, different rates, different valuation, which is important when you keep going. But also, when you stick with one bank, you only get the ideas or the option that is with that one bank. So you're leaving a lot of option and opportunities on the table.
So let's talk about Commonwealth Bank, 'cause I love talking about the Commonwealth Bank. If I go to the Commonwealth Bank direct, like me, Phil Tarrant, how many, well, they'll probably just tell me get lost and they can't give me a home loan because I'm too complicated to try and do a deal with. But how many products would there be available for me? There'd be like 2 or 3. They go, you get X or Y?
3, let's say 3. You'll have a basic loan, a loan with offset, and a fixed.
And that's pretty
option.
much it.
That's it.
With some variations of the interest rate
and
they can give
and
me.
the policies and the rules are the same for those 3 products. So if you don't fit that, well, sorry, can't help you.
So people think now, and this is sort of coming out what's been happening inside of the media recently, some of the scaremongering you've seen from AFR is saying, would you go to, did you know that an evil mortgage broker gets $16,000 or something other for writing a home loan? You're paying that. Like they're just spreading so much information at the moment around this, right?
So
Whereas if you go to a bank branch, you don't have to pay that money.
Yeah.
Like
You just pay it directly to us.
First, the clients are not paying that, right? Then it's not the client paying
that's
us.
not what you would think, right? Like
No, they're not paying us. And the average is 0.65% of the loan amount that we get upfront commission.
yeah. And it's completely disclosed and everything.
Yeah.
And-
It is disclosed. It's in our credit guide. Clients have to sign it. They know exactly how much
Paid by the bank.
paid by the bank. Correct.
And if the bank doesn't pay the broker, the bank keeps that amount. This is
Well, they've got to pay it to their own staff. And I hear Commonwealth Bank again that they've got so much trouble sort of trying to get their own proprietary bank staff to write loans. They've had to like double their commissions.
Yeah.
Or their bonuses and stuff outside of like the norms.
Yep.
Like saying, well, you get, if your base salary is this, you get 30% or 40% on performance. If you do this, we'll give you even more. So they're
Correct.
struggling with productivity.
And I think, what does this mean for the average person trying to acquire an investment loan? It means nothing as far as the bottom line. I think that's the big part here, is that the rate that they can get charged if I went directly to CBA versus going to an accredited broker, it should be exactly the same.
Should be.
And that's what it means for the consumer. And that's the big important part here, is that the key for a good broker is that they're not just looking at CBA, they're looking at a teledext of 30 other lenders. And to Eva's point, ideally lenders who are probably going to be more niched with a correct product and other things which will point on not just rate, but also making sure that the structures, everything else is going to allow them to continue to build a portfolio. But the actual rate itself won't differ whether it's a broker channel or directly through the bank. And that's
in theory,
in principle. And it should. And that's the way it should be, because consumers should get the best result and they should have people working on their behalf, as opposed to just thinking about who can clip the ticket the most on the way.
Yeah, I find I don't like having one of anything, right? Like I always like to create competitive tension with everything I do, particularly friends. Sorry.
I thought you'd get that one through.
Oh, you've got to do it. Got to do it. But, if you have multiple lenders and multiple bankers, you can create competitive tension. I do it all the time. Like, I like the bankers I work with, but I'll go, well, I'm getting this over here. Why aren't you giving me the same? Well, policy and this going, oh, really? They'll give me more of it. Like,
show me the policy.
Yeah, show me the policy. Like, I want to stay with you guys, but ... So you want competitive tension for the purpose of, ensuring that you're getting the best possible pricing at any point in time. And as you become a more significant investor and you end up with a lot of properties, it's a headache, but you can use this to your advantage. So don't fall into that trap. And particularly connected with this fourth point, which we'll get into in a moment. Welcome back, Phil Tarrant, Smart Property Investment, chatting with Eva from Finni and Paul from Pure Property, chatting about the 10 most seen investment mistakes. Now, before the break, we're talking about sticking with only one bank. And you probably see, Eva, as a result of sticking with one bank, you end up in this problem. Probably one of the biggest mistakes, number 4, is cross-collateralization, where a bank will go, well, you're entering the top of your serviceability, but if we cross-collateralize your properties, might be able to give you a few more bucks.
Yeah,
is that how it happens?
That's a lot of the fixing we do, is crossing, if you might say it that way. So crossing is just when one loan is secured by a few of your properties. So then it's an issue to release equity. It's an issue to refinance one property. It's an issue to do everything, really. If you want to sell, if you want to keep going into your investment journey. So banks do that because they're lazy. It's a lot easier, and it would be a lot easier for a broker as well to do that.
Because you can do it, right?
Yeah, we can do it, definitely. It would be so much easier if I did that. I would do a lot more in the same amount of time. So it would be easier. It just wouldn't be the right thing to do.
Yeah.
It gets people really stuck, and often people have a lot bigger potential than what they have realized because of that. So we do a lot of uncrossing.
See, the cynic in me, which I'm not a cynical person, anyone.
Thanks do that. Thanks love to do crossing.
But brokers as well, right? Because, and I'm not saying brokers do this, but like the cynic in me says banks do it because it just means the client's stickier. It's harder for them to go away. And a broker would probably do the same because it means that it's harder for them to go away because of its cross-collateralized around it. So is there any benefits? Like, is there any genuine benefits through, I don't want to be the demon of cross-collateralization, but is there any good in it? Like, when would it make sense to do it?
A family pledge is crossing properties.
Yep.
So that's a good
point.
Definitely a good option there.
So just on that point then, if you're buying an investment property and you're getting a family pledge around it, they'll tie up the new property and the existing property of your parents packaged up in one thing, so you wouldn't need to unpack that.
For some while though, not forever. As soon as your loan is 80% of the property you bought, so as the property go up in value,
they release it.
You can release it. So
and
it's
is
only
that
for
easy?
a few years.
Paperwork, or
you
is it
do evaluation of the property you purchased, and if it's 80%, we do a partial release.
And that would actually benefit the lender because it means they keep the loan. Because if you had to refinance to get rid of the cross-collateralization, they would lose the loan. Okay.
Yeah, so that's pretty easy to do. And that's a really good option, right? Crossing. But otherwise, there's no other reason why you would cross. Just it's easier. You end up with less loans.
So it's a bit of a myth.
But I don't see any reason why someone would say, I really want to cross because...
I can give you an example of it, and you probably don't know this because this person might not have disclosed it, but it's a client of yours who actually I sent through for a property we secured on the Gold Coast very recently for a development site. Now, I won't name names of who it is, but you'll know exactly who it is. Right. They're actually a professional sports person.
Oh, okay.
But they've recently retired. They spent a lot of time, and actually you've had them on this show, Phil, a long time ago. They spent a lot of time playing sport, earning good money, but at the time, they were busy, right? Traveling around the world, doing what they did for a living. And they had one bank really early in the piece, associated with CBA, not CBA, but essentially gave them a really good deal. They had some certain products for professional sports people, which then allowed him to basically say that he had a broker at the bank, branch manager, stayed with them his entire career and built up a portfolio of a dozen properties in that time. Properties did really well. Every single one of them was cross-securitized, every single one. Now, to your point that you just brought up there, Eva, one of the simple things when I spoke to him, because I was nervous and I looked at him like, I really wish you haven't done that, or can you change that? And he said, I don't want to. And he had his reasons why, but his main reason was when he opened up his net bank, he had one profit and loss line and essentially said, my assets are worth X, my debt's worth Y, and I kind of look at it, that's the way I like it. As long as I haven't got dud properties that are going to go down in value and then it risks the entire portfolio, that's his perception of why he had that in that position. There's obviously big downside risk to it, especially with a big portfolio.
Less loans, obviously it's easier to manage for somebody, but is that a real benefit just because it's easier?
Some people really like simplicity. And I mean, not me, but again, if you ask any investor who's got 5, 10, 15 properties and they've got 3 or 4 different lenders that they're with and they've got 3 or 4 different logins, 3 or 4 different apps, if you ask them, would you prefer this to be literally just on one page? I would put my hand up straight away and say, yes, I'd like that, but I know it's not in my best interest to do so.
See, I go back to point number 3, sticking with only one bank. I don't want them knowing.
But you are naturally suspicious and untrusting.
You have to be naturally suspicious and untrusting.
But you want to be uncrossing that client you're talking about?
You can absolutely go for it. Have a crack now. But they've stopped playing sport professionally, so it might be a little bit tougher. So, and this is where the challenge is, though, because once you're there, to uncross that now, that'd be an absolute hornet's nest. And I dare say it's probably not possible because the serviceability is probably not there anymore. So what they've got...
We'll find a way.
Well, reach out and
I'm
have
sure
a chat.
I think I know who you're talking about. I'm sure he's got a nice bank manager that likes him and they get on well.
They don't like it. They don't like you as much once you stop earning the big money, right?
Oh, really?
Yeah.
Then
you're like, what else can they do?
So you know purpose, no use to him anymore.
Potentially, right?
Yeah.
Like you're
That's why you need a good private banker who, when you're not giving him money anymore, they don't like you no more.
And who finds some more insurances to sell you. Yeah. All right, we're very cynical. Very cynical.
Welcome to the Cynical Investors Podcast. Paul Glossop, Phil Tarrant, where your misery is assured. Only investing in your own name, Eva, the 5th mistake that people make.
Yes, there's a lot there. Obviously, that's what people do first. They will invest in their name with their wife, 50-50 or a different percentage. They forget the SMSF often, self-managed super fund. They forget that they could invest in a trust. And sometimes to do that earlier in the journey will allow you to do a lot more than if you bought 3-4 properties in your name. So that's obviously something that's financial planning and we wouldn't give advice on that. But that's what
Insert disclaimer.
Disclaimer. Yeah. But really, when you do invest in a trust and your trust is positively geared, we can ignore that. So technically, you're saving your capacity for the next and the next.
Sorry, I need you to explain this again. And we've spoken about this once upon a time. So if I'm a property investor and I have 4 properties in a trust, wherever, and the net result of that property investing is the trust is positively geared, i.e. I don't have to tip in any money from anywhere in order for it to be self-sufficient. The lenders will just ignore it.
Correct.
Like, is that a fact or you got to say, hey, don't look over there, nothing to see?
Look, not all bank, but what we see at the moment, currently, what I can do is ask the accountant of the client to provide a letter saying trust A, B, C are self-sufficient.
Yeah.
I can ignore the debt. So if someone, let's say their potential was, let's say $2 million in lending, if $2 million are in a trust, I can still borrow $2 million.
So we'll get to a point where they have to look at it to see it before they don't worry about it? Like, do you still need to provide all the information?
No, I go up front with my letter and I say, don't worry about it.
It's all cool.
Yeah, and that's where an accountant really, I mean, they obviously put their name to it, so it's their neck on the line. So if they're going to be fraudulent, they've got big problems.
Yeah.
And we're not
certainly... Good tax return, right? They would see,
absolutely.
They would know.
Yeah, so it has to be legitimate, but ultimately it's not the bank deciding whether it's legitimate. It's the accountant making that decision to say, here we go.
Yeah, and accountants run by a pretty tight code of ethics.
Correct.
And
even if they're not, they've got the ATO to make sure that they are to scrutinise.
Does it just have to be $1 positive, or it's got to be like really positive? What about if it's $1 negative? Will that be an issue? Then you're going to have to provide.
I don't see the tax return. I just need my letter.
So you get the letter from an accountant and just go, don't worry about that, sweet. So it makes everyone's life less painful.
Less painful. I'd say there's always, the risk of the person itself. You have to know, okay, if you've got $2 million in lending there already and something goes wrong, you'll have to support 4 million now, right? So you still have to be careful, but in theory, the trust lending allows you to save your capacity and use it again and again and again.
And that's good
pending
for property
it's
investors.
positively geared.
Yeah, and I've sort of spoken about it, not for a little while, but I think there is a negative bias of banks towards trust-based lending, and or they'll gouge people inside a trust more than what they will outside a trust. And good luck good luck if you are investing inside a trust to see interest rate reductions if and when rates start coming down as fast as what they would come outside of trust-based structures.
There's a bit of a premium.
Yeah, there's a premium to it. And also that makes the government a bit nervous as well. You know, I hear they're not happy with people investing in trust because they reckon it's probably one of the reasons why housing affordability is as high as it is and tough as it is, because there's a lot of evil property investors out there with positively geared trusts.
It's got nothing to do with the 41% of tax that is acquired for any purchase/development to finish it off. 41% of.
No, let's not talk about that.
No, let's not talk about that.
That's the developer's privilege to provide all those funds.
And GST.
Yeah.
We talked about this earlier, Philip.
Developers love paying GST.
Oh, it's a fantastic tax.
Someone's got to pay. You got to pay
sense.
tax. We all pay our tax.
Yeah, no, I don't pay any tax, Philip.
Oh, do you?
No, of course not.
Nothing at all.
Yeah.
So only investing in your own name, and there's a premium across a number of different levels if you don't invest in your own name, and I don't have anything personally in my name, which means that from day dot, pretty much for everything, depending where you're investing, you're paying land tax, right? Like that's a premium you've got to pay. It's a cost of doing business. Typically, it means your accounting fees are going to be more expensive as well if you're investing outside of it. It means you're not going to get as many tax-effective breaks in your own income that you generate. Like so, there's a lot of consequences to not investing in your own name, and most accountants will probably say you should probably have a couple, right?
Yeah.
Like because it's the most tax-effective structure up until a point to be able to hold property investment.
And I've got a question for you, Phil, because you just made that point. You've bought a lot of property over the years and none of them are in personal names. But that being said, out of all those properties you bought in trust, was the intention to maintain borrowing capacity, or was the intention to look at how do I distribute profits and protect my assets?
Yeah, more of the latter than the
there.
former. Like I've never had really much of an issue with serviceability because I don't invest as much of what I probably could. For a whole bunch of different reasons. But for me, it's more about continuity. It's asset protection, not the major thing, but continuity of assets is probably where it's at mainly.
And that's the one thing I see is that working with thousands of property investors, you kind of look at it to say, well, client could have 10 properties and you could have half of them in a trust, half of them in personal names, whether it's joint tenants, tenants in common or the like, and have different splits as far as ownerships. But when it comes down to it, if you're going to buy property in trust, you still have to figure out how to get deposits available to perpetuate the portfolio and keep buying more property.
You've got to get the deposits in there.
Exactly. And that's typically cash, right?
Yeah.
Like, and to keep a portfolio running positively geared in this day and age with probably about a 7% interest rate attached to it for a trust.
It's getting harder. People would buy like joint income properties or build a granny flat.
And then you wonder why are you buying that property? Is it just to get a positively geared asset to buy more assets? And are you buying an inferior property potentially just to buy more property? And then it starts to curtail, why are we buying these assets? Are you buying questionable properties in questionable locations just to tick over a percentage of an 8% yield versus a good quality 5% yielding asset that's just going to see far more capital growth? And you're just holding more assets with more headaches that aren't actually going to do the heavy lifting for you.
This is when you need a good accountant, right? Because I know a lot of people, they have different trusts for different uses. So they might have a trust which is really high income generating and they're distributing the profits of those into other areas. They might have deliberately run up trusts with negative retain negative balances on it for the purpose of maybe
offsetting llama farms.
Offsetting a llama farm. Or offsetting a sale of a property in time, right? That gets really tactical and you need a really good accountant who, number one, back to my point, is it plays by the rules of engagement and the code of conduct connected with accountants and in the eyes of the ATO. Like, it's really important. You've got to get that right. Play within the rules, absolutely, but play hard within the rules would be my recommendation.
Is it the thin edge of the wedge, though? I mean, like we talk about this trust. I know we've sort of gone down a bit of a rabbit hole here with trust itself, but when you think about the fact that it's only 1% of property investors own typically 6 or more assets, I mean, are we really talking about this 1% club here? And is this why they become the 1% club, or this 1% club people who actually inherently have a higher income, have more disposable cash, maybe are business owners, maybe high net worth individuals outside of property?
I'd say the former rather than the latter. I think it's a mindset thing rather than a financial capability thing.
Yeah.
And what normally happens is that if you get the first thing right, the second thing follows.
Yeah, fair call.
Would be my view.
Yeah.
A lot of people I know, you must, I know a lot of doctors who make a lot of money.
Yeah.
And geez, they make some dumb property investment decisions.
Most of them make the worst decisions, unfortunately.
You sit there and just go, what are you doing?
Why?
Like, why? Why are you doing that?
Because depreciation.
Yeah, you need depreciation. Kind of negative gear.
Pay a lot of tax.
It's one of the greatest property strategies in the world, negative gearing.
My dear Lord.
Oh, God. I'm being facetious, by the way, everyone, if you're new to this. But number 6, and I've never done this, really, unless I get angry. Focus on the rates rather than the options.
You never get angry.
No, never. I'm the angry-less property investor. I sometimes get a bit fatigued with it all, particularly but most people that come to you probably aren't that obsessed by the rate. It's more about the outcome of getting the loan set, right?
Yeah, and I think it's, as you mentioned, it's a mindset. So if people come from having their home where the whole decision of choosing a bank was rate-driven, they're a little bit like that when they come to investing. And it takes some time to change the mindset to understand, okay, well, we might actually go to a bank that's a little bit of a higher rate, but that will allow you to do a lot more with your capacity, with your valuation, with whatever it might be. And it takes some time for them to understand that also as an investment, the rate is not so important because negative gearing that you guys really like. And
negative gearing's fine.
it's great.
Depreciation's probably one of those buzzwords which I'm like, yeah, get it. It's great to have it, but I don't buy it.
Brand new
because of
property.
it. Yeah.
But even that's changed now. Like, you got to work hard to prove it's a brand new property because the developers
and you can still
probably
claim depreciation
GST.
on non-brand new property, by the way, for anyone who thinks it's only brand new property.
Is that what Brad Beer would tell you?
Well, Brad Beer, there's plenty of good quantity surveyors who can educate you on that. So go and
Insert plug BMT. Otherwise, he won't buy us a steak dinner next time we see him.
I haven't had a steak dinner for a while.
Oh, yeah?
Fringe benefits.
But just be warned, people that try and sell your property based on depreciation benefits. That's it. I think podcasting has pretty much sorted that out. Doesn't happen as much.
I hope to think so. Some of the good work. There's limited good work you've done, Phil.
I've been working hard. I'm waiting for my Audit of Australia for services to property investors.
You might be waiting a while.
I don't know. Hopefully one day someone will nominate me and, get a little pin, Could be there on the Queen's list, honours list.
That'd be the king these days.
It would be, wouldn't it? Yeah, there you go.
But, I mean...
So the rate matters? Doesn't matter?
Well, it does, but...
It definitely does.
It definitely does, but not
I
as
thought
much.
people only use mortgage brokers because you get a better rate.
Well, we do. We have what's called the BID, best interest duty. So we have to take people to the best, cheapest interest rate based on the product that is available to them. But sometimes the rate is not why we choose a lender.
But you said
to
also,
understand-
we'll chat, I can't remember the lender we were talking about, but it said if you go to REIT, you're going to get no features, something with features and offset, right?
Yep.
The more features you get, the more expensive the interest rate.
Technically,
Yeah.
a premium if you get the offset and what have you. But yeah, the rate shouldn't be why you go to a bank, especially when you invest.
Yeah.
That's the main. And I've seen people refinancing away from what we've done and then realize the mistake they made. Come back. Can you bring me back to whatever?
Do you go, nah, you've burned us. You're dead to me.
That's it.
I can give you a number of real average broker.
Yeah, that's what you think. You're not saying it, but that's what you're thinking. Yeah.
Does it happen very often though?
Yeah, it did
lot.
happen. They go on
So
those.
people go, I found another broker
Yeah.
and they can get me at a cheaper rate of
Yeah.
20 basis points.
Yeah.
You stitched me
Yeah,
up.
a lot of those online lender, which most of them don't have offsets, so people refinance, have their cash sitting in the account, and then they realize suddenly that the great rate they got there is nothing compared to how much more.
So they might be getting 3% in the savings account, whereas they're paying an interest rate at 5%. They can't offset it, so there's a gap of 2% and they're getting dudded.
Yeah, and some of those don't do equity release, for example. So if you want to look at investing,
So there's some products you get it, and then you go, hey, I've got all this equity. They go, no equity. So you got to refinance.
Yeah.
Okay.
Yeah.
I didn't know
Or
this. This is why you
it's
need a mortgage broker.
like maximum 60% LVR, but they won't tell you this until you pay the application fee, the valuation fee, the everything fee. And sorry.
That sounds cynical.
Sorry.
She is French. It's natural there as well.
In case
The
you
French
didn't hear
aren't
it.
normally cynical.
No.
What are the French normally? Here we go.
Just rude. We're just rude.
Here we go. I don't know. How do I classify the French in a public setting? Friendly? Like a chat?
I'm sitting right next to you. Phil.
Okay. I like the French.
Yeah.
But I'm going to call foul on this next point of the 10 most seen investment mistakes. I don't think you've written this. I reckon this is it's been jimmied in. If anyone's watching this, it's written down here. Not using a buyer's agent.
I was only made aware of these points about 5 minutes before going on air, so I can.
Do you generally believe that?
I do. I really do. And the mistake I've made is when I did not use a buyer's agent.
Or why?
For example, buying wrong location, wrong type of property. I can't stress enough the unit bloody mistake I made.
Okay.
Just looking at the wrong information and getting stuck on the
Sour
wrong numbers.
maybe would be the right term. Sour.
She's soured.
Sour. So what does it matter from a financing point of view whether or not you use a buyer's agent or not?
Oh, look, if you buy one property, it probably won't matter. But when you come back for the second, if you don't have growth there, well, there's no equity, you can't go again. If it's really bad rental year, well, you can't service, you can't go again.
Yeah.
If
So you won't
it's-
get rich being a property investor if all you're doing is tipping in your own cash into assets that don't grow.
Yeah.
It's probably the simplest way to look at property investing ever.
It's not complicated.
Yeah,
It's
but,
not
but
complicated.
it's often you see people that have 2-3 properties that just did nothing, that actually eating away their savings. So it's not all
Beer and Skittles.
pink and sunshine and
Yeah. What's the equivalent in French for beer and Skittles? Is that an American term? Beer and
wine and
Skittles?
cheese.
Yeah.
Wine and cheese.
Yeah, well, that's
It's not
probably-
wine and
I like
cheese.
it's not all wine and cheese. One thing I would probably point out with that too, Phil, is that
Well, maybe we should call this wine and cheese, but it won't be the sort of stuff made of milk curds.
right,
The cheese is probably a lot of your sayings that you say.
sure.
Yeah,
This is
maybe.
going in some
Missed it.
complete, I've completely lost what I was going to say.
Yeah,
Yeah.
Scuppy didn't see that. It's a buyer's agent. That's why you shouldn't use a buyer's agent. They can't keep their train of thought. Come on, you got
Too
it.
many deals
Did
in
you bring
one.
it back?
It's coming. It's
Get it
coming.
back?
No,
Come
it's
on.
not there.
No,
It will come back.
nothing. Welcome back,
It's what-
Phil Tarrant, Smart Investment with Eva and Paul. 3 more 10 most seen mistakes. Maybe we should do this over wine and cheese. Good Chablis.
This is you probably get a lazy Susan in the middle of this here, and
It looks like a lazy Susan
I
type
reckon
of thing,
that's
isn't
the
it?
next edition.
Let me choose the one then.
There you go.
Yeah, like a matching
You got a
wines.
Chablis fan over here.
I do like a Chablis. That is, it's my go-to white wine when I'm particularly eating some poissons, fish. No,
What?
what's
Buff.
a little bit. I like a Chablis and Cheval. Not reviewing your options with a broker every 6 months. So this is pretty important. It's not set and forget with a mortgage broker, is it?
No, it's not just about getting your loan sorted and then set and forget. It's also checking on the rates, checking on the option. You might have some equity earlier than you think, or there might be that we put you with the bank A and things changed and you actually could be much better off with bank B now. And I'm thinking of the self-employed on a low doc option, or people that didn't have the opportunity to get really a good mortgage at the time, but didn't want to miss on an opportunity.
So how do you know something has changed enough for you to worry about speaking to your mortgage broker? Or is it just don't throw it to chance, just call them up and say this has happened, what do you reckon?
We check anyway with our clients every 6 months roughly, but if you change job, if you finally got your tax return done, if there's a big increase into your rental income, I don't know, a kid that's 18 now, don't have to add it, like a lot of those things.
There's so many key points here.
Moves
Like
the
just-
needle, right?
Yeah, and I think
Credit
the
cards.
biggest point that you brought up there, Eva, and I can attest to this as I built my portfolio early in the piece, is that I hassled my broker all the time. And reluctantly, he answered the phone when I called him and always wanted
Do
more
I know
money.
your mortgage broker?
You do, and you very clearly know exactly how he'd answer, and very, very lethargic and never proactive. He's still a very good friend. He's actually a very good broker. He's just very lazy. And the point I have here, though,
You've ditched him now and you use Finni,
I
right?
have.
Yeah, good.
I have. And the reason being, though, I guess the reason why I bring that up is that you brought up, like, do you call your broker? A good broker should have processes in place to say, you know what, even if it's every 6 months, it might be literally saying, how's it going? Has anything changed? Status quo. Sometimes it goes more detailed to the point of saying, oh, you know, your son Tom, I realise he's finished his HSC, he's now turned 18. He's now not a dependent. You know what that means? That actually changes your serviceability and other things that might happen there. You know, rents have increased by 17% in the last 12 months in the area that you had that property. I'm assuming your rent's up now, maybe $5,000-$6,000 a year. That's actually ticked you up by X. We've seen 14% growth in this property here. Let's do a valuation, see if there's anything more available. They talk about, oh, you got that promotion, or you've gone back from mat leave now to 3 days a week. So many different things happen every 6 months, and this is what a good broker's job is. And I find that they're an enabler. And if they're not doing that, they're going to be the ones who are actually a roadblock as opposed to the enabler. And the best investors I have within pure property investment have fantastic brokers behind them, because they're the people who've enabled. Yes, the purchase and the property does a good job, But without the broker being proactive, if you're not trying to get finance for that next investment, you're essentially sitting idle and you're letting everything go by.
So do you guys actively call your clients?
6 months, yeah.
Well, what about for people who spoke to you and didn't do anything? Do you call them back and say, hey, are you doing anything yet?
Yeah, we follow up clients as well. But what we try to do is, anyway, if someone can't do anything, and that happens, sometimes just no option, we just tell them, okay, well, you need to achieve this, this, and this.
So you'll give them a list of things to do.
I give them goals, and it's like, once you reach this, or one of them or two of them, it's time to have a chat and check again. So it's not a no, it's come back to me then.
I thought mortgage broker only spoke to people if they knew there was a deal to be done. Is that me being cynical again? So you'll actually give people a thing going, hey, go away and do
to-do list, homework.
You're off the mark.
Yep.
Go away and do this.
Yep.
And when you've done that, we can help you out.
So we had Beck a few months ago. She just told somebody, just go and get a pay rise. And he just changed job, completely changed industry, came back with a higher income and got the deal done. And he said, thanks, Beck, because I would have never actually made the move otherwise.
Changing people's lives.
Yeah. I think it was
This is why
awesome.
it sickens me when I see mortgage brokers getting beaten up in the media.
The heroes.
The heroes.
But I don't make a big deal out of it, but you think about it, most of the stresses in people's lives today originates through or the origin of it is some sort of financial stress, which exacerbates.
Not enough Chablis.
Well, not enough Chablis. And it exacerbates out from that. So, I sort of joke about it, but a broker can actually make your life better by helping you on that financial side, which has consequences across your personal happiness and health and your relationships and all that sort of stuff, right? So that, recommendation, he's gone away and done something about it. It's probably changed it. It's like a real sliding doors moment for him, right?
Yeah. No,
maybe that could be a new name for a podcast, Sliding Doors.
Oh, sliding doors.
There you go.
Well done.
Yeah.
Well done, Philip. Been thinking about that one for a long
time. No, I haven't. I just thought about it. No, but often, because you get so detached from the reality sometimes of property investment, right? Well, you do a lot of it and you talk a lot about it, which it just becomes a thing, right?
Yeah.
And you sometimes forget that there is heightened emotion connected with property investment and finance and mortgages. It's the epicenter for a lot of people. They might think about it every day, but it's probably a thing that has consequences to a lot of things that they do. So when you talk about, hey, if you've got a principal place of mortgage and you haven't had your mortgage review for some time, that's not like a mortgage broker going, hey, I want to refinance you. It's like, hey, things might be better for you if you just spend the time going to speak to your mortgage broker.
Yeah. Absolutely.
It could be game changing.
And to use another analogy, it's best practice to go and speak to your healthcare professional just to get checkups sometimes, right? You don't need to be, essentially, you don't need to be symptomatic to go and think about, I need to get a checkup. Sometimes it's good to be proactive, and a lot of the time that proactivity can just lead to saying you're on the right track, don't do anything. But one thing this brings to my mind is that we're probably 6 to 18 months away from a big groundswell of change, and that change is interest rates changing. Now, if anyone's really thinking what would be a good time to maybe get in touch with my broker, when that happens, I can vouch firsthand that when we do start to see this rate cycle decrease, which will happen, we're going to see a huge amount of opportunity within both the markets, but also for people who are holding debts to sharpen what they've got, to try and think about how to extract equity, to see their serviceability increase. Yeah. All these things are going to play out.
So my view of that, Paul, and I agree with you, is for a lot of property investors in particular, the way in which you're going to be able to get sharper rates is through refinancing. I can see a lot of malaise with the banks in passing on interest rate savings. They're going to make it hard. Yep. You're going to have to fight hard to get savings on your interest rates. And if you want to spend a time, energy and effort working your lenders, and they're going to be providing sharper rates to new to bank customers. They're not going to be passing it on to inverted loyal customers. And people go, well, that's not loyalty. You go, well, banks are in the business of making money. I've got a lot of shares in banks, so I get it, right? They've got a return on the investment. So don't expect the banks to be benevolent when interest rates start coming down. They're going to make it tough, right?
Yep.
So you've got to be ready. And this is a point here, Eva, it's perfect timing, not being prepared for the next opportunity, right? Like whether that's a buying opportunity or a rate cycle, which is in a stage of flux. You need to be ready for what I'm deeming the great refinance. There's going to be a huge amount of refinancing at that point in time because people are going to be frustrated with banks because they're not going to be able to get the same rate they're offering you to bank loans. And that's not a beat up on banks. That's what banks are going to do. And they're hoping that the average lazy Australian don't open their mail and have a look at their interest rate, which happens. It must happen, right?
Yep.
What's the highest interest rate you've ever seen and just gone, what are you doing? Are you mad? Why haven't you had this refinanced?
Recently an owner-occupier debt close to 9%.
Wow.
With a major
Healthy
bank?
LVR.
Yeah. Healthy LVR, yeah, because it's been there forever. Yeah.
Far out.
You're kidding me.
No, it's just someone that just let it go up.
See, that's
and
criminal.
Up, and up and up and up. And then suddenly realize, it's a bit expensive now. And looked at it and realized,
This actually makes me think, when's the last time I checked my rates, to be honest with you, because I think I've been a bit tardy in the last 6 months personally. Actually.
Ask me last time I checked.
Yeah. When did you last check?
This morning.
Yeah, I was about to say, knowing you probably, this is one of the things you do check regularly.
Yeah, I'm right across it. And, you've got to watch it, particularly if things are coming off, fix the variable, all that sort of stuff. And
that
the
was
only
used
way
like
you're going
3% higher than what it needs to be on.
It's crazy. It's the stuff that come off fixed the variable. And I was expecting it to come off at the same rate I have variable interest rate loans with those mortgages.
Reverts back to the 1.1, 1.5%.
It was 3% higher.
Yep.
It was like, no, I said,
goodness.
what are you guys doing? And I had to fight hard
That is
to
insane.
get it to, hang on a second, I'm paying interest only on
How much
this
was that
here.
loan, by the way? Like, what's the dollar value we're talking here?
$1.5 million bucks.
So $1.5 million bucks at 3% more on top. So we're talking $40,000 a year. Essentially just via being passive versus being active. And the bank's happy for that to happen.
And so the story is the same asset, 50-50, right? 50%, half of the loan was variable interest only, the other half was fixed P&I. So the fixed P&I come off onto variable P&I, and I was sitting there going, well, I'm paying this at a variable interest only. I would expect the P&I loan to be maybe 20 basis points cheaper.
Yep.
3% higher. And I said to him, guys, same asset. With St. George Bank, by the way. Same asset.
By the way.
The same asset. And I had to fight hard. I did some podcasts on it.
That is vicious.
I couldn't understand it.
And you wonder why banks get a beat up.
Yeah, and I don't want to beat up banks. I like banks. Banks are cool. They lend money, But what I'm saying, though, some guy paying 9%.
Yep.
So you've got to be on top of it. And being prepared is knowing what your interest rates are.
Yeah, and then probably we should do a podcast on what to do to actually get ready to refinance if needed.
Yeah, I think you got to get ready. Look,
And if you're unsure, probably
see
call
what it
Finni
means,
because I tell you what, they'll give you a checklist of things to actually get in touch with.
Maybe we should just provide the checklist, or you want people to call you up, obviously. Can I have your secret checklist?
No, we could do a podcast on this because there's lots there, depending on the
Yeah, and again, it's I'm not beating up banks, but this is the way banks work, right? And if you look at it cynical or what, but and no one knows. The commentary I saw coming out today on the basis inflation's actually ticked up a notch a little bit. Don't expect rate rises until late 2025 now, right? So let's assume you're not going to get any rate rises this year. Rate reductions this year, and inflation's going to be a problem, which I've spoken about this beforehand. The government has made promises to Australians in their budgets that inflation will be under control by Christmas or early in the new year. Good luck with that. But if there's no rate reductions coming into the mid to late next year, you've got some time to sort your stuff out. If you haven't got your tax returns done, if you haven't done this, haven't done that, you've got to get ready now.
Yep. It could be that it's also worth refinancing already.
Maybe.
No?
Yeah.
If you're at 9%.
Well, definitely if you're on 9%.
How do you find out what interest rate you're on? This is a really simple question. If I'm
just go
tuning
on your
into
net
this,
bank. On your statement,
it'll tell you, any bank statement will tell you what your interest rate is.
Yeah.
Okay.
Yeah.
So point number 10. We've gone for a lot longer than I expected, but it's good stuff. Not thinking about diversification. Is that in property or other assets? I don't know. What you probably invest in some mink coats or something or other. Or
Velour.
Are we talking about diversification in property or in assets?
Yeah, in property.
general?
Actually, it goes back to the point of using a buyer's agent. Otherwise, people tend to buy what they know. So they would buy a house to live in. They would buy the house next door, or property they know. They would keep buying, the same units in 2 or 3 different suburbs, or just the same all over. So it's great when everything goes well, but when maybe in that suburb when everything goes down, then they actually don't have any opportunity to keep going. So if you spread your eggs a little bit, maybe different state, different type of property, different type of, then there's always one that performing well, so you can keep going to the next.
So if you've got at least one eye in the fire that's getting equity increases, you can keep trading.
Maybe you'll have one asset that's not doing so great.
Yeah.
But there's one maybe, I don't know, this year in Perth that did great, and you can get equity and buy somewhere else.
Well, you must see a lot of people's portfolios. How many do you see a lot of people clustered in like orange? I've got 50 properties in orange. Does that happen?
All the time. All the time. I tell you what, and this is where you can get stitched
I'm not
up.
saying orange is a bad place to invest in, by the way.
Not either. But one thing I do see, and it's probably not only location, but it's asset types. And I'm not going to name names here, but most of the time, and whether someone's done it on their own volition or they've had a buyer's agent assist them in buying certain property types in a certain location, there's typically always going to be a bias to something. And inherently, it's typically, there's two ways I see it. A, it's off the plan, and someone might go for a splurge to say, look, you can buy 5 of the, and you brought up healthcare professionals. I said a lot of the time, healthcare professionals attend a seminar and all of a sudden they're stitched up with 3, 4, 5 off the plan properties within a very tight geographical location.
Stitched up sounds like a negative term.
That's what it is.
Maybe slightly cynical.
Yeah.
But they're not going to complete for 2, 3, 4, 5 years. They're going to put maybe a small deposit down of 5% holding, and then they're hoping that, you know what, that's 5 years problem, but I've got this great depreciation, great tax deduction, and I'm going to buy these assets. I'm going to earn all this money anyway, so it's fine. I'm just going to.
It's all going to go up in value.
It's all going to go up in value, assuming that I'm going to get all this rise before it's even constructed. Most of the time, it plays out the opposite way. But
sometimes it works.
Sometimes it works, but less often than when buying established based on data, not by my opinion or others, based on data. But that is one way that I see that there is huge risk. The other risk that I actually see, which is maybe a little bit counterintuitive of what we're discussing, but when people go down the pathway of buying multiple assets, lower priced assets, be it $150,000, $250,000, even $300,000 properties, which might be 1 or 2 bedroom villas, because they can afford it and they think the game is a game of how many properties I can buy as opposed to quality, compared to quantity. And all of a sudden I've seen portfolios, again, by wealthy people who have exposure and ability to do a lot, but they end up with 20 or 30 assets. A lot of them are in highly regional locations and they're buying 1 and 2 bedroom apartments in areas which have huge amounts of available supply, and they bought them because they were cheap, and they bought them with the assistance of someone who was making a clip of the actual
What's
asset
the biggest
themselves.
portfolio you've seen? In terms of numbers of property?
165.
Okay.
Somewhere in that range.
Were they like good assets or?
Most of them good.
Yeah.
That one comes to mind. Most of them good. Very good investor. Big portfolio. Absolute
full-time
brain tease.
investor, that's all they do?
No, but they did employ someone to do a lot of their full-time books and a lot of other things that go with that. But I do see, I commonly see probably someone with between 10 and 15 assets. That's probably more of a common, probably higher net worth investor who's been at it for a long time. And they split into those two categories. But most of the time, it's rare that I'll see an investor with 10 properties plus that'll hold rubbish. Yeah, and the reason being is because that rubbish just doesn't perpetuate. And when I say rubbish, I use that term loosely, but it's probably to those two categories that I just mentioned. It's rare that I see a very well-rounded portfolio that consists predominantly of those property types because they just don't enable more to happen.
It's a really important point. So the only way to actually build a large portfolio in terms of number of properties, and I would say also large value, is through buying the right properties. Because to the earlier point I made, you don't get rich in property by putting all your savings into properties that don't grow and go nowhere.
Exactly.
So, yeah. Success leaves clues.
Yeah.
There we go. All right.
Yeah.
You've never. What's the biggest portfolio you've had to refinance all in one go? Like imagine trying to get financing on. It must be positively geared in trust because the lenders don't want to worry about it, right?
Exactly.
Like how many properties have they had to show in order to get?
There wasn't that many, like 15.
Okay.
Yeah.
Yeah.
I mean, it's still a lot.
Still a lot.
And,
Yeah.
as you said, a lot of, I guess, rubbish type of property in there, serviced apartment and.
Oh yeah, so there's some classics.
Yeah,
there.
classic
the service
there.
That's a really good.
studios.
Get a good tax deduction.
Oh
on that,
my
don't they?
goodness!
It's all about the tax deduction.
Goodness gracious me!
We're coming up towards tax time, so and I would mention that the ATO is having a look at investors and how they're claiming certain things. So ensure that you file a correct and appropriate tax return would be my hot tip. That's what our friends over the ATO will tell you. They've been on the show talking about that as well. So if you're not confident in doing it yourself, get an accountant. And if you choose an accountant, make sure you use someone that actually knows property investment would be a hot tip from me.
Me too.
That's not advice or recommendation. It's a hot tip. It's a hot tip. And only get advice from people that you trust will giving you the right advice. And if someone's giving you free advice, question it. I'm sure we'll hear about that tonight, the Pippa Awards.
No doubt.
Yeah, who's
the
big
free
on that
advice
sort of
category.
Stuff. The free advice, best free advice. Best
the
kickback,
Razzies.
kickback of the year. It happens
Yeah.
in property though, and this is one of the biggest issues with property investment. It's still unregulated. People's trying to working hard on it. I know.
I'll finish up with one thing that I was actually talking to Eva about earlier today, Phil. Is I've got a client right now who contacted me yesterday out of the blue, and they came through a referral from an existing client. This is an extreme, but a common occurrence where we've got a client who's been through a property, loves it. It's in a new development in Parramatta, one of the biggest developments in Parramatta that's ever taken place. Sub-penthouse, on the market for $2,060,000.
Sorry, what is a sub-penthouse? Is that the floor under the penthouse?
Yeah, and for me, it's just it's a bit of a joke term because it doesn't really mean much. And you look at what this is, it's a unit. Okay. It's not on top. That's sub-penthouse. But the point I'm trying to make here is that it's still being sold through the developer. Now, I know through my experience that I get contacts and calls from developers all the time asking if we're interested in promoting certain developments, and we don't buy brand new off the plan. Now, they wanted to buy this property. We definitely aren't recommending to buy it, but it's as an owner-occupier. Now, I knew straight away that if I went through and spoke to this developer and asked the question saying, well, do you have channel agents that you're selling these properties through? I'm assuming there's going to be a margin that you'll pay the channel agents. And it took a bit of coercing to get the information out of this particular person. But invariably, they came back and said, look, there's a margin of about 3 to 5% depending on the actual unit itself. So I said, okay, great. Thank you for telling me that. What I've done from there is I've essentially assumed now that if they're asking $2,060,000, firstly, I've got to figure out what the square metre rate for this development is, and there's hundreds of units in this development. So there's plenty of comparables that I can figure out what the square metre rate for a good purchase should be. I can inform my client of saying, here's what the good rate should be, but I can also inform you too that I know that if I went and bought this property and acted on your behalf as a channel agent, I could get potentially up to a 5% commission off purchase price. $2 million, do the math, 5% of $2 million. But I guess my point here is that we charge a flat fee, regardless whether it's a $2 million or a $200,000 property. So what I would then inform the actual person responsible for selling out this project is, I don't want that commission, but I want you to make sure that 5% comes off where this price would be, in addition to the fact that I know the purchase price should be here, landing at this price compared to this, and this other unit. It works out to be a couple of $100,000 difference. But that could otherwise be a commission check to a channel agent, and a channel agent. Is
that what they're called now? Not a project marketer.
Project marketer,
channel agent.
Channel agent. Yeah, there's all kinds of
opaque, isn't it?
But again, it's illegal, Phil. And I guess to your point, mate, is that this is the part which just it irks me to no end to know that legally you could do that, and it's huge bickies, and you can see why people are incentivized to do it.
It's legal or illegal. It is
moral.
legal.
It's immoral.
Well, I wouldn't say that either. I think the issue is that whenever you're buying anything, it's buyer beware. But you can't make an informed decision if you don't have all the information. So the issue I have with it is that it's very opaque and it's not disclosed. Or if it is disclosed, it's in such small fine print in a contract that no one's ever going to read that it happens. So, people are going to make money somehow, right? Probably whatever, but there needs to be a level of disclosure and transparency with all this sort of stuff. If you know, by buying this property here, that the person that's recommending you to buy it is potentially making a commission of $100,000. If you know that and you're happy with that and you proceed with the transaction, that's fine.
Yeah.
It's all about disclosure and transparency.
Agreed.
However, I would imagine in the scenario you just painted then, the developer doesn't want to be selling direct to consumers, even though someone's not taking a commission, because that resets his price point down on what the assumed price point is, right? That's not good. He's got to say the price that he sold it for was the net, not the gross, right? That's the comms. And then that devalues the development. Again, it's opaque, right?
Yeah,
but this is the way it works.
Yeah.
And that's why that's okay if that works that way. People just need to know.
They need to be aware before signing.
They need to be aware.
Yeah. No, mate, you hit the nail on
and knowing that it's actually a good build as well.
Yeah, which you unfortunately just won't know for some time down the track. You might know on the reputation of the developer and a few other things.
There's lots of things. Maybe we can do a thing on development at some point. But is it easier, Eva? We'll close with this question. Is it easier to get finance on established properties over off-the-plan stuff?
Yeah, 100%.
So it's harder to get finance on off-the-plan properties?
Yeah.
And why is that?
Often it doesn't value for...
So the lenders will want a different LVR or something or other? Or?
Yeah, and the other thing is, not often, but sometimes there's no real comparables when it's in an area where let's say it's the first building there that's new-ish. So there's nothing there. So they're comparing to all the units, doesn't value up. And also when it's on completion for years to come, sometimes 2-3 years, it's really hard to know what the value is going to be then. So how do you prepare and have a pre-approval? It's going to expire in 3 months. You never know if you're going to get the finance. Your circumstance might change.
Interest rates go through the roof.
Interest rates go through the roof.
Years.
So
Imagine committing to off-plan purchase with 1.59
right.
interest rates, and now they're up over.
And this particular
close to
development
7.
had heaps of sales in 2020, 2021. And you can imagine these people doing their math on a completion of X, and now they're not going to foresee 14 interest rate rises in that time.
Yeah, so it could be like someone like this went to Bank A and they got a great rate, and now they have to go to a third-tier lender and end up with actually 9% because they can't afford it. So yeah, it's tricky off the plane.
Well, we've covered lots of ground there. Thank you, Eva. Thanks for being the voice of reason and sensibility. Don't get pulled into the stupidity that is the discussions on the Smart Investment Show. But no, thanks for all of your insights. And I'm sure people can just call you guys up and you talk to them about any of this sort of stuff. Yep. How do they find you?
Finni.com.au.
Okay.
Yep.
Good. Paul, thanks for tuning in.
Thanks for
We've
having
probably
me.
got some stuff to talk about, I think, on some other podcasts moving forward. So stay tuned, stay informed, stay connected. smartpropertyinvestment.com.au. Social media, you track us down, Smart Property HQ, or just search Smart Property Investment. You can see what we're up to. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.